because you need supply. You need a lot of supply for values to come down. But there were a lot of people that gave away equity, and that's why we had a sizable downturn in prices during that time period. Yeah, even if the Fed was going to do what if you make the Fed do something like that, it's going to have a hard time getting people to flood the 10-year as a result of that. It's just not
that kind of stuff. Yeah.
Yeah, because you got to look at the long-term stuff, and I just don't see there's just no reason for it to go down right now. The job market, labor market's way too strong. Good news is we're almost into June. We're going to get another labor report at the first week of June.
Mm-hmm.
And especially in higher cost areas, that differential in interest rates really makes a difference in buying power.
Yeah, it really does.
You really see it open up in like Orange County, as expensive as everything is.
All right, everybody, welcome back. I'm Jason Thibodeau, your host with the Mortgage Lounge, and I have one of my favorite guests, as always, with me today, Mr. Stephen Thomas, with reports on housing. Hi, Stephen. How are you today?
I am excellent. Thank you for having me.
I guess I should have the microphone next to me. We know what we're doing here. But, it's an interesting time in the industry right now. I just interviewed Logan Moshami last week. Got to chat with him a little bit about what's going on from a national perspective.
Yeah.
Because he's more of a national guy.
Yeah.
You're our local guy.
Sure.
And I know all of our clients and realtors want to hear about what's going on. What's changed this year, as far as I can tell, I read your housing reports every 2 weeks?
Mm-hmm.
Yeah, every 2 weeks. It's really nice to have those updates. I have my notes here. Last year we had, 2,600 homes in Orange County at this time. And today we have, 45, almost 4,600 homes.
Yeah, big difference.
Yeah, a big difference. And I think we might agree on this, but can you tell us why you think this is finally changing after we're in the 4th calendar year of higher for longer,
right?
Which started in 22, 23, 24, 25. And we all hope that something will change eventually. But at this point, this is the new normal. I'm assuming it's because, homeowners and life has to move forward at some point, right? The duration, and here we are at 7% in 2025 still.
Right.
At some point, your life moves on and you have to move sometimes.
Yeah. Really, it boils down to, these higher rates for longer. After a while, waiting for rates to come down, people are just so tired of waiting.
Yeah.
We hit the actual 36-month mark, so 3 years. August of 2022 is the last time we had interest rates in the 5s. And at this point, nobody believes that we're going to get into 5s anytime soon. And there are more people that believe they can even go higher, although we don't subscribe to that. But there were a lot of people. Once we got into 2023, that was the year where after rates just skyrocketed higher from 3.25% all the way up to,
that was our most brutal year.
Yeah, to practically the mid 7s, and it was such a shock to the system that there were homeowners that actually were giving away some of their equity to move out at the second half of 2022, thinking that there would be another Great Recession style loan.
Sure, interesting.
And I even know some lenders that did it and
just wanted to get out of Dodge.
Yeah, they were caught because later they thought that the market was going to turn, and they definitely weren't listening to what we were talking about. Because you need supply. You need a lot of supply for values to come down. But there were a lot of people that gave away equity, and that's why we had a sizable downturn in prices during that time period. Then you roll into 2023, and just about everybody, they were talking about date the rate, marry the house.
Yeah, marry the house, date the rate.
Thinking that
there's some regret happening right now. For sure. Because we're not allowed to say that term anymore.
Yeah. It is definitely. Anybody saying, I actually heard somebody say it, and it caught me off guard. And I was going, like,
yeah, that's not a thing anymore, guys.
Yeah, there is no more dating the rate, marry the house type of thing. You you marry the rate, marry the house, and you might be able to upgrade down the road.
Yeah.
That's about it. I would not be banking on anything to change. So in 2023, as a result of that, everybody's saying that, homeowners believed it as well. So why in the world would they place their home on the market and go buy something else, knowing that, hey, you know what, later on their rates are going to come down? Yeah, they were just waiting for that to happen.
Oh, I'm having an epiphany right now. So what you're saying is the consumer, the homeowner has come to terms with reality.
Right now. Yes.
It took 3 years.
Yeah.
Essentially, right?
Yes. One of the biggest things that I see right now is there are a lot of people out there that feel that buyers are on strike. They're not buying because things are overpriced. That's not what it is. There's only a certain number, a segment of the population that can even buy right now
Because of the affordability factor.
because of affordability. So you only have a certain segment. It is the same certain segment that is able to afford a home every year. So demand, pending sales activity, isn't changing at all. Year over year over year. What's changing are the number of homeowners that are tired of waiting. And in 2023, that was just so low that inventory levels actually, they were grinding down lower.
How low did we get in 23?
It was ridiculous. We were
Roughly speaking.
It was in the twos, and that's just too low.
Yeah.
So when you're that low,
Peak inventory is in the 2000s.
yeah, right.
Yeah.
It just doesn't make much sense. And we saw that in all markets. All markets, we saw inventory levels were the normal, like where it elevates and then hits a peak and then comes down. It looks like a nice little mountain. We didn't see that at all.
So here's the counterintuitive thought, right? Everyone's dying for lower interest rates. But maybe the Fed and this higher for longer mantra has a silver lining to it in the long run. And I know it's slow and painful.
Yeah.
But if we continue to hover around 7% for another year or two, don't you see that? Is it possible that you see inventory get to a place where we actually have balance in the Orange County and LA County marketplace, or maybe we're already almost there, and therefore prices, not only are they not going up, they stabilize or even drop 1% or something like that? What's your thought on that? Because it feels like the longer this goes on, eventually something's got to give.
Yeah.
And we'll actually kind of get what we're looking for, not in the form of lower interest rates, but in the form of more choice and more affordable housing prices. I don't know.
Yeah, we've actually already seen that in some areas, like the state of Florida, the state of Texas. There are some tiny little communities that have seen like a 8% correction in price year over year, but it's a county with like 200,000 people.
Yeah.
Those are like small, and those are the examples that all these perma bears and
the doers
that run out to these places.
We get it. Austin isn't doing well.
Yeah. So at the end of the day, it's not really, we're not going to see major pushback where prices come down like crazy. We are already seeing there's a bit of balance already.
Yeah, I mean, last year was what, 45 days on the market this time last year, and now we have 85 days on the market.
And so that's the velocity. I call it the velocity of the market, the expected market time. People like to use days on market. I'm not a fan of days on market. My velocity speed changes as like right now, for example, we have very flat days on market, and it hasn't really gone up that much. And the reason for that is because we're in spring and a lot of homes come on the market. So it's artificially low, but we know that that's not really the reality of the marketplace, which is why I even started doing this expected market time statistic back in the 90s, because it's the true speed. It's the speedometer. And when you get a ballooning number of homes on the market and demand remaining the same, if we have a lot more homes than last year and way more homes than 2 years ago and similar demand, what's happening to the market?
Yeah.
It's really slowing.
Yeah.
Even though this is the time of year where a bunch of homes come on the market, average days on market's not going to show you that. So we're seeing a real balance across all markets, and in some markets like LA, already there. It's already at the tipping point where they're going.
They're at balance, right?
They're beyond balance. They're going down a little bit.
Are we gonna say here in this podcast that LA is in a buyer's market right now?
It's slight. It's so slight.
Yeah.
It's slight where nobody's giving away the farm. There's a lot of equity in the system. When there's a lot of equity in the system,
You're not no price corrections or anything like
there's
that.
going to be no price corrections.
Yeah.
Unlike what the doomers and all them say, because when you have a lot of equity, what's the point of giving it away?
Right.
And there's a real stickiness to that. Banks back during the Great Recession, when there was foreclosures and short sales, they were in charge, and they were unemotional. They are not emotionally attached to these properties, and in order to
these
sell
people are.
they are. Homeowners are attached.
Well, the other point is
emotionally.
the housing expense itself. Like, these folks likely got in during COVID at 2.5% or pre-COVID at 3.5%, and their property tax base is way lower than it would be today. And it's just they don't have a huge housing expense. So what's the rush to sell if you don't have to? I think people confuse this with 2008 out of I don't know what the word is, inexperience. And I think people think 2008 was just like, oh yeah, this happens all the time.
Yeah.
That was like once in a almost half century or century anomaly, right?
Yeah, since World War II, there's only been really one correction across the United States.
Yeah.
And there was a savings and loan scandal in Southern California and the Bay Area where we did see values come down. So across the United States that year, I think values went down like 1%. I think it was 1990 or 91. And that was a savings and loan scandal. It came down a lot more in Southern California and the Bay Area. And that brought down the rest of the country to negative, because there were other parts of the country that were actually positive during that time period. So, but once again, who caused that? That was the real estate industry.
Yep.
And who caused the Great Recession?
The real estate
industry.
It was a credit crisis too, though. Like
right. On top of it, you throw that on top of it.
Yeah, I mean, people got loans that shouldn't have. Everyone was over leveraged and overextended, and that's just not the case these days. 30-year fixed at an average rate of 3.5% across the board means, in a lower property tax base, at least here in California with Prop 13. It means your housing expense is a lot lower. It's just a different market, and it's nothing like, sorry, doomers, it's nothing like 2008, whether you like it or not.
Yeah, it really is not. There's the products. Everybody's stuck in these fixed rate mortgages.
Yeah,
and they're with great credit and great jobs, and people are talking about, well, unemployment's going up. It's going up from like decades low.
We've been sitting at 4.1% for like a year. Like, it's historically low.
Yeah. Well, we're at 4.1. I think it's 4.18 right now, or 4. And so we're slowly making our way up from very low. It's just not that much unemployment.
Yeah.
And the jobs picture is really good. If unemployment goes up a little bit and ticks up, could it cause a recession? Yes. Are we going to go into recession? Probably not at this point.
Yeah.
But we're definitely going to get an economic slowdown later on this year.
Well, there's a lot of uncertainty too, right? We got the tariffs, the 90-day pause. One day it's this, the next day it's that. We don't really know what to think or what's actually going to happen. You got the big, beautiful bill that may or may not pass the House. So much for spending cuts, right? Like, I was so disappointed, like everybody was. Outside of the political pom-pom waving, because I'm not that guy, I was very hopeful that Doge and Congress would follow Doge's lead, and this spending bill would have meaningful cuts. We're at a $2 trillion deficit right now. Like, not only is that not sustainable, there's also a reason interest rates are remaining elevated. Like, the bond market wants to be compensated for that.
Yeah. Yeah. And you actually saw that last week, and we're seeing that in the market.
20-year bond action.
I saw it again. And you're seeing it even today. I was like looking at the 10-year, and it's up, and there's no reason for it to be up.
Yeah.
The only reason is because of they just don't like the direction of things.
Yeah.
So they want to be priced for the direction of things, and that means higher rates.
Well, you got uncertainty. You got no change in the spending, the drunken sailor spending, which we were all hopeful for. I do like Scott Bessent, the new Treasury Secretary, and I know he's a smart guy and well respected, and I really hope he has some influence I think his goal is to get the 10-year Treasury right below 4% at 3.9 is his target. We got there for a brief moment, right? And then it went right back up with the tariff.
Yeah, even if the Fed was going to do what if you make the Fed do something like that, it's going to have a hard time getting people to flood the 10-year as a result of
Yeah.
It's just not
That kind
gonna-
of stuff. Yeah.
Yeah, because you got to look at the long-term stuff, and I just don't see there's just no reason for it to go down right now. The job market, labor market's way too strong. Good news is we're almost into June. We're going to get another labor report at the first week of June. But I've been watching initial unemployment claims, and they've been really low. So there really is
Those don't budge.
there's no sense of urgency for why would the Fed want to cut and then put more capital into the markets that there's more capital, there's more spending, and so then we have another inflation problem. So they're caught because the administration is trying to put their thumb on them and tell them how they need to cut, and they really can't cut because they're worried that the tariffs are going to bleed into inflation numbers, and they're going to.
Yeah.
And I've had to pay more for a couple of big ticket items, and they said, sorry, it's because of the tariff.
Yeah, Walmart, Amazon are talking about increases in prices because of that. So with all this being said, back to like Southern California market, we see LA responding in a big way with a pretty significant inventory increase. Obviously Orange County too, but maybe not as much. I'm really curious, like, do you think this inventory trend continues up until the end of summer with its growth, or do you think it levels off at some point? Because right now we're at 4,500, 4,600. Are we getting to 6,000 by September, or what's your thought there?
Yeah, it's interesting. Even at 6,000, it's still shy of where we were prior to the pandemic.
Right.
So in Orange County is one of those counties where we're far below the pandemic numbers. But for all of SoCal actually crossed its threshold of the 3-year average prior to the pandemic,
Including LA and the other counties.
Yeah. So I like looking at the 3-year average rather than 2019. 2019 was actually artificially higher.
Oh, really?
At this time, it made its way down because if you remember, we were coming off of 5% interest rates in 2018 that everybody was freaking out about. And
Boy, wouldn't we love to have that today? Yeah. Perspective has changed.
sight is
Give me
definitely
6.25.
Yeah. Can you imagine we were complaining about making it up to 5%? It was right at 5%. So, but what that did is it created inventory back then. So we started off 2019 with a lot more inventory. So when we're comparing right now to 2019 levels, let's start. I want to hear everybody comparing it to 2019 levels at the end of the year. So that's why I like to look at averages. So we looked at 3-year average.
What was the 3-year average pre-COVID?
It's close to I kind of don't have it off the top of my head.
No worries.
County, but for SoCal, we're there already.
Okay.
Like I said, so what that's going to do, it's going to continue to increase over time because we're right now in spring, and summer market for me starts June 1st.
And we're there. At least
there.
this weekend we're there.
Yeah, so there you go. We're in the summer market. And what happens with the summer market is now demand's already peaked, and we start to see
Demand's already peaked. That's right. April.
pending sales activity.
Spring busy season.
Spring is the busiest season. Does that mean that we don't put a lot of pending transactions together in June? No, not at all.
So you're going to see demand drop a little bit and taper off over time.
It's really slow summer. People don't notice that, but what you do see is that inventory continues to rise. So if the inventory continues to rise and demand starts to slowly go down, what happens is the market slows as time progresses, which is why spring is the absolute best time to sell. Yeah, actually, even prior to that, this year ended up being February.
Yeah,
interesting. It was this hottest point of the year as far as the speed of the market. So peaks typically during the summer are falling further along towards the fall, and even
as far as their inventory goes.
Yeah, right. As far as inventory, we peaked as late as Thanksgiving in many markets. So when we get peaks that, like in Southern California, due to the sunshine and all that stuff, peaks for the inventory happen between July and August. Others, it's between August and September, and for the United States, it's around September. But it's been close to Thanksgiving and or earlier and during the fall for some markets that peak earlier. Like,
So we're definitely breaking the 5,000 number then in Orange County.
yeah, I'd be absolutely shocked who didn't break it. But do we make our way up to 6,000? Probably not. Probably just shy.
More or less 5,500.
Yeah, right. Exactly.
You heard it here, folks.
And you've also heard that values are going to go down for the second half.
Yeah.
What's mainly? It's like that seller that goes, yeah, they're waiting for an offer, waiting for an offer, waiting for offer. They have something in mind. They look at the comps. They know what their value is, and it's $5,000 below.
Yeah.
Are they going to pull the trigger? A lot of times, yes.
I mean, if it's $1,000, oh yeah.
Right?
Yeah.
Now they're saying, yeah, 5,000, and that's how you get the values to come down slowly. You're not going to get somebody that gets an offer, it's $50,000 below what the comps are showing and all this stuff. They're not going to buy.
Well, it always takes a consumer a long time to catch up with reality. You know what I mean? Because especially
homeowners that are holding on to bad equity.
Yeah. I mean, they're very emotionally attached to a certain number, and that's understandable. But it's also important for the listing agents these days. Their job is slowly getting more challenging.
Yeah.
Right. Because you can't just take a listing and immediately have it sold anymore. It depends, right? I'm sure there's stellar properties that are going to fly off the market still. But with the inventory growth, while it won't be a buyer's market or anything, it'll just be closer to balance, and you'll have to incentivize. And that means getting the seller on board with initial pricing, right?
Right.
Or
That's so important.
offering seller credits, buy downs, things of that nature. Correct me if I'm wrong.
Yeah. Well, we show statistically that if you have to reduce the asking price, you net less, and the more you reduce, the more the more money you're throwing away. And I've been arguing about.
You mean like as a starting point?
Yeah, you know what? Yeah, you come out that original price. You better have spent hours and hours upon hours coming up with that. It's interviewing the real estate professional is important. Arriving at your price is just as important. You only get one shot at an initial first impression.
It's kind of that first 30 days, right?
Yeah, well, you have that first impression, and you come out of the box. If you're not priced right, the whole buyers are savvy. They know what prices should be when they look at it, and it's out of price. It's overpriced. It's overzealous is what we call these sellers.
Well, demand, right? Demand's just not there like it used to be,
and buyers won't pull the trigger on it.
Yeah. I mean, it's one thing when interest rates are 3%. They're not right now, and we do have a homeowners insurance issue in California right now. Every time I'm creating an estimate on worksheets for clients, I'm now doubling my estimate for homeowners insurance. Right? Mm-hmm. The old adage, depending on sales price, I always threw in $100 a month. Before.
Right
now, it's at least $200 and sometimes $300 a month for homeowners insurance, and of course, in fire zones, it's $500 to $750 a month for homeowners insurance. Boy, has that changed things.
It has, and it's California is coming up to where they should be priced insurance wise.
Right.
They were like 17th on the list of all states. They weren't in the top 10.
They should be.
Yeah, they should be in the top 10, right?
I wonder where they're at now.
Yeah, they're still not in the top 10.
Really?
Yeah.
Well, I know that has to do with the state government. Right. They're allowing the insurers to actually increase premiums. Otherwise, there's no incentive for these agencies, these insurance providers, to even be insuring in the state, right? Because so many have left.
Yeah, well, you had Logan in here before, and he said they're not the March of Dimes. That's what he likes to say a lot. They're in the business to make a profit, and if California is going to make it impossible to make a profit,
why would you do business there?
So they've left. Yeah. People go, wow, these insurance companies can't believe they're doing it.
No, they're not a charity.
It's just like them. If they're doing something, you want it to be profitable. Right. They want the same thing. There's no reason for them to operate in the state of California if they can't be profitable. Yeah. So they've left. But now California is realizing that, which is shrewd of them because they're learning from the state of Florida. The state of Florida did the same thing. They're way ahead of California, and they had the biggest disaster.
Yeah, they're even worse than us.
They're even way worse.
Yeah,
way worse.
No wonder people are having a hard time there.
Right.
Yeah. Yeah. No, it makes sense.
Yeah. Florida's having all that. They have the insurance issues. They have, and they went up so much in price. So we went up a lot in California. They went up even more in Florida.
Yeah.
So when all of a sudden things changed and you have the disasters and things like that, you have a lot of people placing their homes on the market.
Logan is team higher rates, as from what I can tell from interviewing him and what I know about him. Would you say you're team higher rates as well?
Yeah, I mean, my base case for this year was 6.5 to 7%, and if you wanted to stick me on a certain interest rate, I said 6.75, and we were hanging there for a while.
Pretty accurate. Did you see the just quick segue, and then we'll wrap it up? Did you see the Orange County Register article this morning?
On
It was interesting. You know, it kind of had a doomer feel to it. Orange County sales plummet 31%. Is the Fed to blame? Payments increased by 122% in 6 years versus 25% increase in Orange County incomes. This is back to the affordability issue.
Yeah, this is it's really easy to create these articles, and these articles are created because of the affordability issue. But when you have interest rates that are hovering around 7%, and that's just way too.
It takes a lot of people out of the market.
Yeah, it takes a ton of people. And then once we get down to 6, you saw what happened.
Oh, we were busy.
47 days below 6.5% with no points.
Yeah, no, I'm telling you.
7 days, that's it. And it was amazing.
Yeah, refinance volume skyrocketed, purchase activity noticeably increased.
Yeah.
And we were like, oh my gosh, is this what it could feel like?
Yeah, we were in Orange County had a 10% bump in demand, and it never gets a 10%. Never gets a bump in demand. Period.
Yeah.
And I've been doing this since 2004 in the month of September.
I mean, if I'm at sub 6.5% for a 30-year fix on average, I'm doing great. I really, really hope we can get there. It's definitely frustrating, all this lingering.
It's going to take a break in the labor. We'll watch it because I think later on this year, people are going to get that break in the labor. I am team rates are going to come down a little bit.
Yeah. Yeah. No, and the thing is, I miss them, like in closing, like what I miss as a loan officer is the move up buyer.
Mm-hmm.
All right. Because most people cannot go non-contingent. Right. And the idea of someone selling their house at 3% mortgage with a low property tax base and then trying to figure out in this inventory environment what house they can afford. I was just chatting with a client yesterday who was going to have, $500,000 in net sales proceeds, needed 1.2, 1.3, and their property tax was going to more than double in price, and their interest rate was going to be, 6.75 more or less, and that meant they were like, oh yeah, I can take on about $5,000 a month, and they were thinking 1.2 or 1.3. Well, $5,000 a month with what they wanted to do was like, $800,000 home.
Yeah,
it's not going to work. It doesn't exist. So, this is the hard part. We're talking to plenty of people, and they're all saying, "Oh, I'm sorry, what? What was that number?"
Yeah, right.
It's just is what it is.
And especially in higher cost areas, that differential in interest rates really makes a difference in buying power.
Yeah, it really does.
You really see it open up in like Orange County, as expensive as everything is, when you come down to 6%. I go to church every Sunday. I say this over and over again, and I actually pray for 6% rates.
Yeah,
it'll
thank you, by the way, Stan.
Well, it's not only great for the real estate industry, it's good for millennials and Gen Zs because they've been waiting. They've really been taking it on the chin.
Yeah,
to deal with COVID, then they have to deal with high rates. It's like one thing after another. And there was such a limited amount of supply that who was losing? Millennials. So I'm really rooting for millennials, but I want to do
such a good point, Stephen.
But I don't want to be in the 5s.
Yeah,
I don't want to be.
I don't want to see like an inflated price war again.
That's my reason.
I think what we're all looking for here is balance.
Sure.
And I think 6.25 roughly, more or less, gives us that balance and gives millennials a fair shot and returns move-out buyers. And also that means move-up buyers are sellers, so a little bit more choice in inventory. I think it helps everyone. It's not an unreasonable request, is it?
No.
We're not asking for 4%. I get my 6.25.
I get on my knees every Sunday and still nothing. So you know what? It's in his timing.
Yeah, that's
right. We're waiting.
That's right. Yes, and I found I can be very patient, apparently.
I must have prayed.
Whether I like it or not. You must have prayed for it. Yes. Oh, I continue to as well. Stephen Thomas, it's always a pleasure. Let me know if there's anything else you wanted to chat about today, but if not, we can wrap it up.
No, that's it. I mean, it's all about price in this market and not waiting down the road to place your home on the market. It's not going to get better as the year progresses. If you want to wait down the road, well, now you're waiting until spring of 2026. And I don't know what spring of 2026
we have no clue. I guess the only thing I would close with is you buyers out there, the good news is while interest rates aren't cooperating, inventory continues to climb, and that means more choice and more negotiating leverage. Just make sure you're hiring the right realtor who knows what they're doing, okay?
Yeah, well, one last thing with that buyers waiting and trying to time the market is absolutely ridiculous, because we've already talked about how crazy it would get just getting down to 6%. Now, if the economy were to slow and we got those rates down at 6%, all those people that waited, now they're going to be competing, especially in the entry-level price ranges.
So it's counterintuitive, but you have more opportunity right now because of the lack of demand and extra inventory and choice. So think about it that way. And you're not buying an investment vehicle if you're buying your primary residence. That's the reminder. This is a home you're supposed to raise a family in, create memories in. And so whether you buy right now versus 6 months versus 9 months, it's kind of irrelevant. If you find the home that works for you and your family and you can afford it, and you come to terms with the seller with good negotiations, then go for it.
Exactly.
All right. Stephen Thomas, thanks again, man.
Thank you.
Nice work today.
Appreciate it.
Until next time, thank you guys.
Bye.